Welcome to the Dental Journeys podcast, brought to you by White Coat Financial. Whether you're a new grad or a seasoned dentist, we're here to share stories of dentists from across Canada, how they got to where they are today, and the strategies that helped them along the way. Plus, we bring in experts from outside of the dental world to share insights on the business and financial side of dentistry, helping you thrive beyond the clinic.
Today, we discuss an extremely important yet overlooked topic as we demystify everything related to health insurance. Gurtej gives us insight on how dentists should protect themselves and their income as we discuss disability, critical illness, and life insurance. I learned a lot from this episode, and I hope you will too. We discuss strategies to ensure you have the proper coverage in whatever stage of your career you may be in.
Insurance is I feel like the most poorly diagnosed financial product out there. Like, people sometimes set up the wrong investments and all that stuff, but where I see the most mistakes and flaws is really like the insurance space. Because there's like I said, there's a conflict of interest. I think that there's like a very big incentive to sell specific types of products. And obviously that incentive is 100% financial, and you can make a lot of money selling this stuff. But I also think to a degree it plays on emotions. Because if you think about insurance, it's pretty emotional. It's like, think about life insurance. It's like, hey, if I'm not here physically, I want to like financially be here for my wife, my parents, my children, whoever. There's like that emotional side. And then there's also this flip side when it comes to insurance. Like, if you think of an investment, you put money in it and you're like getting your money back, right? Like it's going up or whatever the case is. Insurance is one of those weird things where, like, depending on the type of coverage you get, you put money in it and like you don't get anything back. Like, if you did get something back, that means something terrible happened, like you died or you got sick or disabled. So it's almost like this weird bet you want to lose, and no one wants to do that with their money. No one wants to put their money into something and not get anything back. So like, when you combine all three of those different factors, it leads to like a lot of poor judgment or like poor advice, and maybe a bit of both when it comes to insurance. But yeah, I would say the top three that at least I deal with obviously are the disability, critical illness, and life insurance. But there's so many types of insurance. Like, everyone has their errors and omissions or malpractice insurance. You have home insurance, you have car insurance, you have travel insurance. Like, you have a million different types of insurance, but the ones that I think that are like the most important, or at least they have the biggest impact on like your ability to build wealth and like financially take care of you and your family, are these three: the disability, the critical illness, and the life insurance. We'll start with disability insurance because it's probably, in my opinion, the most important. More than critical illness, more than life insurance, disability is the most important in my eyes. And I feel like every dentist either is signed up, or they have a lot of people come speak at their school, or they go to clubs, and this is the stuff that everyone talks about. Plus, it's obviously a hot topic right now. Today is the 25th of November, so like that change literally just happened today with Canada Life. So but how disability insurance works is it pays out a paycheck every single month, completely tax-free, if you are diagnosed with a disability that prevents you from working. And disability is like a pretty broad term. It covers injuries, it covers illnesses, it even covers mental health issues, depending on the type of plan you have. Like, there's some policies that are injury only, but most plans are pretty robust. They're going to cover everything. And like, I don't want to use like a very overarching, like be very generic with what is covered in a disability. But generally speaking, the rule of thumb that I tell clients is that if your physician, your attending physician, the person you go to for healthcare advice and treatment, says that, hey, Ricky, you can't do your job as a dentist anymore because of, X, Y, and Z, that would be considered a disability pretty much when it comes to disability insurance. Now, you can get different lengths of coverage. You can do 5 years, you can do 2 years. Ideally, you're going to want coverage all the way till age 65. You can even choose different waiting periods, meaning how quickly does my disability income kick in? Does it kick in at 0 days of me being disabled? Does it kick in after 30 days of being disabled, 60 days, 90 days, 120 days? I typically recommend 90 days. So 90 days after you're disabled, you would start receiving your disability insurance in theory. And you would receive this disability insurance all the way till age 65, or until you get better, kind of whichever one comes first. The cool thing about disability insurance too is that, like, if you go on disability, let's say you're on disability for 5 years, and then you're able to get back to work, you get to keep your existing policy. It's not like that policy expires or, is a one and done. And more importantly, it's not like it goes up in cost. Like, if you think about like car insurance, you get into a car accident, like, your premiums are going up. Disability insurance doesn't work like that. If something happens to your health, it's not like your premiums are going to get jacked up later.
Right.
If you have the right policy, it's structured the right way.
Yeah.
Yeah.
And what is it kind of what's like the threshold or what's the maximum that you can get? Does it depend on your income, the amount of years that you've been working and all that?
Yeah. So how much coverage you qualify for is like 100% based on your income. Generally, if you're like practicing, they'll look at your personal tax return. They'll even look at your DPC, like your corporate tax return. And they'll be like, okay, cool. How much money do you actually make? And there's a formula that we use on the back end, but generally, it's about like 2/3 of your income is what you can get covered for. That's generally the rule of thumb, I would say. Now, if you're a new grad or like you're a student and you've never worked, you could still get coverage, but each insurance company has very specific limits on how much coverage you can get. So, like if you're in school, you can get like a CDSPI product. It's called Triple Guard, and they'll give you a base amount. I believe, like off the top of my head, it's 2 grand. I have like a whole sheet that has all these numbers, but off the top of my head, it's impossible to keep track of all them. And then when you actually like graduate and you start practicing, typically you're allowed $3,500 per month of coverage. So that's the max that you can get, like kind of your first year out of school. Whether you go with CDSPI or another insurance company, that's kind of the max. And then over the years, you can increase your coverage if your income also increases and justifies the increase. Which kind of like perfectly leads into the next part. Actually, before I move on to the next part, the max that you can get, again, this depends on which insurance company you go with. Canada Life right now, their max is $15,000 per month of coverage. So that's the max. Even if you make way more than that, that's the max that you can get. Whereas with CDSPI, it caps out, I believe, at $25,000 per month of coverage. Now, what do you actually have to earn to make that? You have to earn a lot of money. Like I'm talking $600,000-$700,000, if not more, to qualify for that $25,000 per month. Because, like I said, it's like 2/3 of your net income approximately.
Yeah. And I guess for if you're a like an associate dentist or like an owner dentist, does that make a difference as well? Because obviously there would be different, potentially different levels of income, but is it more so just based on what your clinical work is rather than the actual business itself?
It depends like purely based on how much revenue you generate. So if you're an associate, whatever you actually earn is what we can use as your income. If you're a clinic owner, there's a separate type of coverage for them, which is typically business overhead insurance. So how you usually want to structure it if you're a clinic owner is you're going to want one policy for you. So for example, let's use you as example. Let's say you ran a clinic, you would want one policy just for Ricky. You'd want his day-to-day bills, his mortgage, his car payments, his groceries, all that stuff covered. That would be like your personal disability insurance policy, and that would cover pretty much income replacement based on what you clinically do work-wise. And like most clinics, you have your clinic, you're going to be paying yourself to your own DPC, and then that's kind of the income that we would use for your disability insurance, your personal disability insurance.
Yeah.
If you're a clinic owner, you would technically have a separate policy. It's called business overhead expense insurance. And really, what it's structured to do is that if you suffer from a disability, like sure, your personal bills are covered, but now you're a clinic owner, you have clinic overhead. And so, in theory, this policy would cover some of the overhead. There's like a list of things that are covered, and it's mainly like fixed costs, like salaries, wages, your lease or your overhead, your loan payments, or at least the interest on those loan payments. Those kind of things are covered under like a business overhead disability policy.
Okay.
And like it's really just, I always tell clients, it's designed to make sure that okay, if you can't show up at work and be an owner anymore, like yeah, you can definitely hire an associate. I've never met an associate who produces more than the actual like principal, or at least works as hard as the principal. Like,
Yeah.
sure, there might be a couple people out there, but they're an anomaly and they're probably going to be a clinic owner themselves at some point. But generally speaking, the associate doesn't work as hard as a clinic owner. Or maybe they're not even, as let's say polished or refined in how much they produce or how quickly they produce. And so you're going to want this because it's going to help reduce some of maybe the difference between what your associate earns and what you earn, and ideally cover some of the overhead. Now, again, there's limits on how much coverage you can get. With Canada Life, I believe it's 15K. CDSPI, I believe it goes up to 25K. So you're kind of going to want two policies as a clinic owner. You're going to want a personal disability policy, and then you're going to want a clinic disability policy, which is called BOE, or business overhead expense insurance.
Gotcha. Okay. And then I guess as a like for listeners, when is, for people that aren't signed up, when is the best time? Is it right when you get into dental school? Is it right after you graduate? I know a lot of people ask that question as well.
I would say the earlier you can get disability insurance, the better. Because like the obvious answer is because the longer you wait, the more the cost goes up. Like, that's obvious. The longer you wait, you're going to pay more for insurance. That's just how insurance works. Every year you get older, you have to pay more. But I personally say, like, the biggest reason why you want it is the earlier you get it, the less likely you are to get declined or have an exclusion or have something removed. I can't tell you how many people I've met who, like, during exam season, they were feeling stressed. They went to their doctor. They told them, that they're stressed out. And, like, their doctor prescribed depression or anxiety medication. Now, it was very acute. It might have only been for 6 weeks during exam period, or like maybe they went through a breakup. Now, all of a sudden, a couple years later, let's say they've never taken the medication, they haven't taken it for like 2 years, they haven't had feelings or symptoms of depression or anxiety. But typically, when you apply for coverage, now all of a sudden it's a pre-existing condition. And you might get an exclusion for mental health issues now all of a sudden. Or like another common one for dentists is back injuries. Let's say you like go to the gym, you deadlift too much and you strain a muscle in your back. That's not even like a car accident or something major. But then you went to physio and you went to chiro and you took care of yourself. You went and saw those professionals that you should see. And all of a sudden now it's in your medical records and it's a pre-existing condition all of a sudden.
Okay.
And so it's like there's so many small things that could pop up that could prevent you from getting insurance. Now, I'm not saying if you had anxiety medication or were diagnosed with depression that you can't get disability insurance down the line. No, I'm not saying that at all. It comes down to the specifics of the situation. I've had lots of clients who've been diagnosed in the past, maybe took medication in the past, maybe even they took time off work in the past. But if enough time has passed between their diagnosis and today, we can usually still get them approved. Or like an ideal situation is even if you were diagnosed recently. Let's say, I was dealing with depression 2 years ago. I was on medication. I took some time off work, but now I'm back to work. Everything's all good. I apply for disability insurance today. I feel like the best case scenario is that obviously you get approved, but like the more realistic scenario is that you're approved with an exclusion for mental health, saying, let's use you again as an example. Hey, Ricky, you're approved for everything. You're approved for cancer, multiple sclerosis, MS, back injuries, whatever. But you're not approved for, mental health issues, anxiety, depression, bipolar, schizophrenia, etc. But we'll re-include it back in your policy if you have no more symptoms for like the next 2 or 3 years. So if you have a clean bill of health, depression doesn't, let's say resurface for you. And I know it's like a weird way of thinking of depression, but let's just say it doesn't resurface for you. You're not on medication. You don't have any further treatment. They'll just say, okay, we'll look through your health records. If you've had no further follow-up, okay, it's re-included back in your coverage. The same thing applies for like back injuries too. That's like the most common, I would say, reason why you want to get your coverage early, because like the earlier you get it, the less, I would say, life beats you up and you have like things that come up with your health.
Yeah. So essentially it's cheaper first and foremost. And then that's, at that moment, you're probably the healthiest that you're probably ever going to be. So, you don't have all these external factors that may come into play later on that may hinder. Yeah. Gotcha.
That's pretty much it. Now, like, even in terms of like features you're going to want on your disability insurance, this is where like I feel like the rubber meets the road. This is like the devil's in the details when it comes to disability insurance. You're going to want a policy that, covers you till age 65 and all that stuff. But the 3 features that I typically like almost always, and when I say almost always, there's very few things in financial planning, like I'm sure with dentistry, that you're like, hey, this is what we're always going to do. The answer is typically it depends. But for me, like almost always, we're adding these 3 features, which is own occupation to your disability insurance, future income guarantee or future insurance guarantee, and then the cost of living adjustment, or COLA for short. And like plain English, own occupation means if, hey, Ricky, you can't do your job as a dentist anymore, but you could still go work in another profession, you're going to be able to receive your disability income and go work in that other profession. And like, there's a lot of, stipulations and like fine print with that. So like, I should probably have said this. This isn't like financial advice, blah, blah, blah. There's a lot of gray area there, but that's generally how own occupation works. Is that like, I don't know, let's say you, are diagnosed with rheumatoid arthritis, your hands, you're starting to lose dexterity. One day you're no longer able to work as a dentist, but let's say you could still be a clinic owner, or you could be a professor, or you could be a realtor, is what I always joke about. You probably make more money doing that than being a dentist. You could still go do that other thing and receive your disability income. And that's really important. And like the big sort of news around this right now has been Canada Life is getting rid of their own occupation rider for dentists. They actually got rid of it as of today, which is, November 25th. But leading up to this, they had this. So like when it comes to disability insurance for dentists, I don't want to go on a tangent here, but like I personally feel like your only good option right now is CDSPI. And like we're not going to get into that. Actually, maybe we will get into the differences between it, but even ever since Manulife stopped offering disability insurance, I haven't done a single Canada Life policy because I've always felt that CDSP. I think I've maybe done two, actually, if I'm being honest. And those two were like very unique circumstances where it made sense for them to go with Canada Life rather than CDSPI. I might be the only person who like really recommends people go to CDSPI because you were on my email thread. I kind of outlined it there. I'm not going to go through it today, but like high level, the criticisms of CDSPI is that the premiums aren't guaranteed and that, Manulife can terminate their contract with CDSPI. But if you've actually done the due diligence and you've read through a CDSPI plan, you'll see in the fine print, in the paperwork, it says you can lock in your premiums for till age 65. And it also says that if Manulife cancels their plan with CDSPI, you're able to turn your group policy into an individual policy with the same features, same guarantees, and same premiums. So that whole discussion of like CDSPI versus, let's say, Canada Life or RBC or anyone else that was out there, I would argue ever since Manulife stopped offering disability insurance, I felt CDSPI was the superior product. So like for anyone who has a Canada Life policy, like sure, maybe keep it now, but going forward, it didn't make any sense. Like I haven't sold a disability insurance product in like 2 years, man.
Wow.
Yeah, when it used to be a third of my income, like a couple
Yeah.
years ago.
Yeah.
So
So I guess to break it down, there's a few options that you can go with. There's Canada Life, there's CDSPI, and then Manulife was an option, but it's no longer an option. And then you can go through banks as well, I guess. Some
Well,
banks.
Sun Life used to be an option too, way before. They're not an option anymore. RBC is still an option for dentists, but professionally speaking, I have never done a RBC policy for a general dentist. The only people it makes sense, in my opinion, to go with RBC insurance is specialists, and they
Okay.
have a fantastic product for specialists. Like it's
Gotcha.
a really solid product. Most of my clients who are in oral surgery or perio or prosto or peds or whatever, if they don't already have like a CDSPI plan or a Manulife plan from back in the day and they're new, we're usually going with RBC in those cases because they still offer a 4A occupation class. They still offer own occupation. They still have a large discount for grads. So it's like there's still a good option if you don't want the group product through CDSPI.
Gotcha.
So like a lot of clients will do that.
Yeah.
I guess like the next feature, obviously I went on a tangent. That's what I tend to do. You got the first feature is the own occupation. The next one that you definitely want is the future income guarantee or future insurance guarantee, whatever you want to call it. It's called the FIG. If you go with RBC, it's called FIO. But really, all it does is it allows you to increase your coverage in the future without health questions, without medical exams. All you have to do is show that you earn more money and it justifies you having more coverage. So it's like, think of that example. Let's say I got my disability insurance and then I hurt my back. If I didn't have this option and I wanted more coverage, I have to reapply. And now all of a sudden on my new increase, I might have an exclusion for back injuries. Whereas if you have this product, you don't have to worry about it if your health has changed or maybe it's just not good timing for you. I should probably add this as well. It sometimes doesn't even have to be like an injury or an illness that prevented you from getting your insurance coverage. I've had clients who just they thought they had sleep apnea, let's say. They went in for a test, and now because there's a pending test, they can't get their coverage until that test is done. And if those test results come back inconclusive and you need, follow-up testing, we can't get you coverage until all your pending examinations are done. Or I've had some clients who, have a surgery coming up, and that surgery, let's say, or they need to go see a specialist. And if you're in BC, I'm sure Ontario's the same. You can't see that specialist for 9 months. Well, then
Yeah.
you're out of luck. You're not getting no coverage until that specialist appointment's done.
I see.
So like that's another reason why you want to get your coverage early and why the future income guarantee is such an important option to have. And
Okay.
then the last one I always say is COLA, cost of living adjustment. Plain English, this just means while you're on a disability claim, your paycheck that you're receiving tax free will continue to go up with inflation while you're on a claim. It doesn't mean that your coverage when you're not on a claim is going up. It just means while you're on a claim, let's say you're receiving $10,000 a month as of 2024, that might cover your bills. 2025, that 10K is going to feel a little smaller. In 2026, that 10K is going to feel a little smaller. So having this option is going to allow you to just keep pace with inflation. And there's different stipulations. You can get like a certain minimum, like 3%. You can get a maximum, like 8%. And it's really just based on CPI. But I feel like those are the three features you're definitely going to want on your disability insurance. There's other features like return of premium and other ones like that where you get some of your money back. I'm personally not a big fan of those. But these are really like the three that I definitely recommend. Anything beyond this, I would say is optional as a dentist.
So with the cola, the third option is just the only time it makes a difference is if you actually activate the disability, like if you have a disability essentially.
Exactly. If you're on a claim is only when it makes sense. And like I've had some clients who are older in their profession and their career and they're like very stable, let's say financially, they're going to work for another 10 years and then they're going to scale back. I've had clients that are that age and I'm like, maybe we don't get this follow. Like we don't add this feature.
Yeah.
Because even if you suffered for a claim, you're only going to work for another 10 years kind of thing. And like, maybe you're even self-insured at that point because you're really, really wealthy. You have passive income, all that stuff. So I would say even that third feature is maybe optional, but it's only optional in my opinion for like much older dentists. If you're young and you're like fresh out of school or even your mid-career, I think you should definitely have it. Because if your career is like another 20 or 30 years and you suffer from a disability today, that's 20 or 30 years that inflation is going to be fighting against you. It's not a good, you're going to lose that battle.
Yeah. That's like when you hear stuff costing pennies back in,
Oh my God. Yeah.
now it's, much, much more. So I guess again to summarize, this is all only up until you're 65. Once you're 65, it kind of just goes away.
Yeah.
There's nothing that you get back if you've never used it.
So yeah, two things there. Coverage till age 65, there are certain policies or certain features you can add to your policy that'll extend your disability, depending even on the type of disability. So there's certain products out there that'll pay pretty much till age 100, depending on like the specifics of it. I'm not going to go into the nitty gritty on that today, but there are generally your policy is going to stop at age 65. That's generally the best way to think of it. And the idea there is that you are going to stop working at 65 anyways, so your disability income's going to stop at age 65. There are ways to extend that longer. You just pay more for those features, or it's like a very specific type of disability that'll extend that. Yeah, so that's that. Sorry, you had a second question in there.
Just like you've paid all this money into it and you don't end up using it. What happens then? It just goes away.
Unless you add the return of premium or ROP, you don't get your money back with disability insurance. You pretty much pay into it forever, and then at the end of the policy, you don't get your money back. If you add the ROP option with Canada Life, and again, like I'm not a huge fan of that option, but essentially you pay for it. I believe you pay for 8 years, and then you get back like 4 years of premiums, and then you pay for 8 years, and you get back like 4 years of premiums. It doesn't make a lot of sense to me. It does jack up the premium quite a bit. Some clients like have it. Some of my clients who like had it from another advisor, they have that option. I personally, I don't know. I don't think it makes sense, but that's not to say it doesn't make sense for everyone. It's just my personal preference on that is I don't see the point in it. I do view my own disability insurance, like my own policy that I have. I'm just viewing it as, money that I hope I never get back. I hope I burn through that and I hope I never touch it because that means I couldn't do my job and I couldn't make my actual income. I never want to be on disability. But I sleep really, really, really well at night. I'm not even going to lie, like very well at night, knowing if something ever happens to me, I can't talk to my clients, I can't make my income, that my house is covered. Like my mom is good, my wife is good, my dogs are good, like everyone's good. The bills are paid, the mortgage is paid, everyone's fine. That's really what it is. I should probably add like one little caveat to this too. From like, this is like a tangent, but budgeting wise, I actually say to clients as well, a really good way to know how much you should be spending is I try to tell clients do not go above what your disability income.
That's true.
So, for example, I believe I can't even remember off the top of my head. I think my coverage right now is like $9,000 a month of disability insurance. The last time I did it, I haven't done an increase in like a couple of years. I should probably get on that. You know how it is. Like I feel like physicians have the worst health because they never take care of themselves. I feel like financial planners have the worst like financial situation because you just don't look at it. But
you're helping other people out there.
Exactly. You help other people, you forget about yourself. But yeah, I believe my coverage is that much. I pretty much make sure that the amount that I pull out of my corp needed to cover my day-to-day life never exceeds that amount. If my lifestyle becomes more expensive than my disability insurance, I'm probably spending too much. Or if anything, I should make sure that if there's anything above my disability coverage amount, I should make sure it's very like optional. I do not need it. Meaning like I could cut it out very easily if I suffer from a disability.
That's actually a good way of viewing things. That's a very good way because people always wonder, how much should I be saving? What should I be, spending? I know there's all these different percentages that people go by and whatnot, but that's actually a really
solid way of thinking about it.
Yeah. It's like I never go beyond my personal disability amount because then I know if I can't work, okay, at least all my like main expenses are covered. My housing, my transportation, my groceries, the things I need for my day-to-day life are covered. Your day-to-day expenses should never exceed that. Vacations and like the fun stuff in life, sure, it can go beyond your disability insurance because those are things that presumably you'd cut out if you suffered from a disability.
Exactly. Any
Um,
like fixed cost essentially.
yeah. I always say too, like, I don't know, for my clients, I try to benchmark it. Like, if you're not putting aside a third of your income, you're probably spending too much as a dentist.
Mm-hmm.
And like, there's a lot of, obviously, there's a caveat to that. It depends on your life, your situation, your goals, et cetera, et cetera. But a lot of my clients, we aim for at least a third of their income. So like, I don't know, if I'm an oral surgeon and I make $1 million a year, you should be setting aside about 300K inside your corp. And if you're not, you're probably spending too much.
Yeah.
Yeah, because then you got to leave the other 2/3 for taxes and your own personal life.
Yeah.
But yeah, that's kind of how that goes.
Cool. Okay, cool.
I think we already talked about like the difference between a group, actually group and individual. I'll just like briefly cover it again. Like I said, CDSPI is a group plan. Technically, it's not owned by you. There's a contract between Manulife and CDSPI, and then you're just one of the people on that group. Whereas,
Mm-hmm.
an individual plan like Canada Life or Manulife, what they used to have, or RBC or even Industrial Alliance and a couple other companies, is technically an individual contract. There's a lot more security and guarantees cooked into that policy. But again, I'm not a CDSPI employee. I get nothing for recommending their products. I don't get paid a commission or nothing like that. I just, when I did all my due diligence, I personally thought the CDSPI plan was really good. And like, I think I was joking in the email I sent out. I've like called them or pretend to be a dentist and ask them a bunch of questions. And then Dr. Sanj and a couple other dentists put me in touch with people at CDSPI. And then I just called as myself and said, hey, I had these questions about the contract. And they pretty much cleared up all my concerns with that policy. So I personally think if you're a new dentist or you're a dentist who doesn't have coverage right now, or you recently signed up for disability insurance, I do think CDSPI, in my opinion, is the best policy out there because you are pretty insulated. But again, talk to your financial advisor, see what makes sense for you, kind of thing.
Yeah.
But that's disability insurance. Like obviously I can go way more in depth, but I feel like that gives everyone a good sort of generalization on it. The next one is critical illness insurance. This one doesn't pay out a paycheck every single month. It's a one-time payment, lump sum, if you're diagnosed with a critical illness and you survive for 30 days. That's kind of how that policy works. And then once you're paid out, the policy's done. It's not like disability where it pays out and then if you get better, it goes back to being normal and then you can get paid out again. You can get paid out multiple times under disability. Critical illness is a one and done. There is a specific feature out there where you can get like a secondary payout, but I'm going to ignore that for now. Let's just talk about like what critical illness is for on the main policy. But yeah, you get paid out a one-time payment 30 days after you survive your critical illness. Now, most policies are going to cover like 20, 24, 25 conditions, depending on which insurance company you go with. And like, there's a lot of companies out there that offer coverage and everyone has their pros and cons. Pricing wise, they're all pretty similar, but there's minor nuances between all the different products as to like which policy you go with. But let's just say there's 24 conditions that are covered under a critical illness. And like the big ones are heart attack, stroke, cancer, life-threatening cancer, by the way, not just regular cancer, life-threatening cancer. There is early payouts for specific types of cancer, but let's just assume it's life-threatening cancer. If I didn't already say it, MS, paralysis, organ failure. It's a big list. I could send out the full list if anyone's curious as to what's covered. And like really, you can use it for whatever you want. You can use it for healthcare treatment. Obviously in Canada, a lot of things are covered, but there are things that aren't covered. Yeah. I've unfortunately had to drop off a decent number of these checks to clients because they've gotten sick. I've had some clients use it to go to another country and get treatment. It's a terrible joke, but I always joke, like if you go to India with 250K, they'll clear up just about whatever illness you got. So you can go to another country and get the treatment that you need. And like some clients, I'll give you my own example why I have my own policy is if I suffer from a critical illness, I'm going to use this amount of money, this lump sum to supplement my disability insurance if I need to, or more importantly, just really make sure I don't have to devastate my financial situation if I have any acute expenses. I don't have to sell my house. I don't have to take a line of credit against my home. I don't have to pull money out of line of credits. I don't have to pull money out of my investment accounts. I don't have to like really just devastate my future financial self. I have a dedicated emergency fund for the illness. And like to take it a step further, it's nice knowing that, okay, if like I get sick, I have enough money for my wife to take time off work. Because if I'm on disability, I'm on disability because I don't know, had a heart attack or something like that. My wife's choosing to stay home with me if she stays home.
Yeah.
She doesn't get to go on disability. And so it's nice because like, what if I'm terminally ill or like there's like a major illness and I don't know if I'm going to survive? Well, like, does my wife really want to clock into work, not knowing if she has more time with me? So it's like, I do think critical illness is extremely important. It goes overlooked in a lot of cases, but I actually think it's the next most important
Yeah.
after disability.
And
Now,
that's kind of like a just a check that you can use for whatever. It's not like limited to treatment or whatever it may be.
you do whatever you want. I've had a client, well, it wasn't actually my client, it was one of my colleagues, like a mentor of mine, and I believe his client got diagnosed with like testicular cancer.
I see.
And I think he just had like a surgery. He was fine. After like 2 or 3 months, he was like back to work. He was okay. Luckily, they caught it early and like it all got paid out. He had a big old check. He just, he was fine. Like then he got a bunch of money for it, and you use it for whatever you want. It's not like the insurance company says, "Well, you have to use it for medical expenses." Like you use it for anything that you want. Yeah. Cool feature about critical illness insurance is that unlike the ROP on disability insurance, critical illness is a little bit different. The return of premium option you can trigger and you get all of your money back. It's not like you only get 50% of it back or something like that. And there's different periods at which you can trigger the return of premium. I believe the shortest time frame is 15 years. So like think of a policy that you own it for 15 years. After that, if you decide I don't want my policy anymore, you can cancel it and get all of your money back. Pretty much every dollar that you put in policy minus a couple fees. And you could do that at year 15. You could do it at any point after that. You could do it at the end of the policy. You get some flexibility. Generally, it's like after 15 years, after 20 years, at age 65, or like at the end of the policy.
Okay.
And I skipped ahead here, but even in terms of length of coverage, you can do 10 years of critical illness insurance, 20 years, 25 years, till age 65, till age 75, or till age 100. You get to kind of choose. Obviously, the longer your coverage, the more expensive it is. And so those are kind of like your return of premium and coverage length options. Now, one cool feature that I recommend to a lot of clients, like a lot of my clients actually have this coverage. My own coverage is like this, is I recommend getting, it's called an increasing benefit rider. It allows you to essentially double your coverage over a 10-year period. Very similar to the future income guarantee or the future insurance guarantee on disability insurance. This coverage allows you to pretty much, double your coverage over a 10-year period. How it works is, let's say I have $250,000 of insurance coverage. After 5 years, my coverage will increase by 50%. So now I'll have $375,000 of coverage. Math is right. Yeah, 375.
Yeah.
Then after another 5 years, my coverage will automatically increase to 500K. And then I have my full $500,000 of coverage over a 10-year period. Now, when you do these increases, the cost goes up because you're older and you're getting more coverage, but you're guaranteed approval. There's no health questions, no medical exams, no nothing like that. You also don't have to submit financial underwriting. The nice thing is you can opt out of this increase if you want to. So like, let's say 5 years pass, you do the first increase, you can do that. And then the second increase is coming along after 10 years. You're like, you know what? I actually don't think I need more coverage. You can opt out of that second increase. Now, if you opt out of the first increase, you can't get the second one. So it's like you can opt out after the first one or before the first one. It's up to you. So that's kind of this policy. I really like it for a lot of young dentists. If you think about like a lot of clients that I work with, they're either fresh out of school or they're like similar age to you. They're married, they have a house, maybe they don't have kids yet, maybe they want a clinic in the future. A lot of major financial changes are going to happen over like the next 5-10 years. And so I would say like, hey, if you feel like you don't need, $1 million of coverage today, but you want 500,000, maybe we get that today and have this feature on so that you can get more coverage and opt out of it if you don't want it. It's a really good feature to have. I have it on my own policy. I usually recommend it to a lot of clients.
Okay, cool. And then I guess in terms of like financials, like I know this is very open-ended. What's a typical amount that you maybe pay a month? And then what does that pay out if anything, unfortunately, were to happen?
I have no idea how much the premiums would be. Off the top of my head, I literally can't even think about it. I think I pay like $215 or something like that per month. And I have a decent amount of coverage. Like I'm at 375 right now. Now, how it works is I generally recommend that you have about 1x your annual income as a minimum for critical illness insurance. So if you're an associate, you make 20 grand a month, you should probably have like $250,000, let's say. And I feel like that's probably like the most common amount of coverage that my clients have, because I feel like most associates, you're probably bringing in around 20 grand a month if you're working full time and like even just doing basic bread and butter dentistry and you're at a decently busy clinic. But obviously I have clients who go way further than that. We've done $1 million policies, or sometimes we can do even more than that. I typically recommend at least 1x your annual income for critical illness insurance. Now, in terms of premium, it really comes down to age, date of birth, like gender, smoking status. If you're a smoker, way more expensive, obviously. So it comes down to your health. Sometimes I've had clients get rated, meaning their coverage is now more expensive because the insurance company has deemed them as riskier than someone with the same age and gender kind of thing. That'll often happen if you have like, let's say your BMI is too high, or you have high cholesterol or something like that. You're technically riskier, and so they might actually increase the cost of your coverage.
That makes sense. This is
Yeah.
kind of off tangent, but does certain, I know because they ask you questions when you're first signing up for these things, do certain like sports or activities that you do that can affect you as well, I guess?
Yeah, 100%. So like if you do like dangerous activities, like I'll give an example. I have a client, he rock climbs,
Yeah.
and his disability insurance had an exclusion, as did his critical illness, as did his life
Oh,
insurance.
no way.
And it pretty much just said if he got disabled while rock climbing, it's not covered. If he had a critical illness that was resulting from rock climbing, that wasn't covered. If he passed away while rock climbing, that wasn't covered. That's just like one example. Now, mind
Yeah.
you, he does like some pretty cool, crazy rock climbing. Like it's not like the indoor stuff. Like this guy goes
Yeah.
outside and like climbs mountains and stuff. But yeah, like little things like that. If you go backcountry skiing, if you honestly mixed martial arts is one of them.
Yeah.
If you're like pretty into it, if you go to like a jiu-jitsu class on the weekends, you're fine. But like if you're like really into it, you're probably going to get an exclusion. There's a lot of like high risk activities that could lead to you having an exclusion. Very rarely will you get a decline because of it, unless it's like very extreme, but typically you're probably looking at an exclusion for it, meaning it's not included in your coverage. If you end up paralyzed because you are like a jiu-jitsu guy and I don't know, someone really beats you up or something, you end up paralyzed, like that could be excluded. It's really case by case, depending on how involved you are in that activity.
Just stick to golf and pickleball.
Yeah, pretty much stick to golf, pick a ball, you're good. Yeah, pretty much, man. Honestly, I would say to clients too, I'm like, be boring doing your application. After your coverage is approved, go nuts, do whatever you want. Yeah, skydiving's one of them too. Bungee jumping's another one. So yeah, there's like a full list.
They're trying to protect themselves as well.
Exactly. And it makes sense, right? If you think about it from an insurance company, they're not going to cover you if you are like wild and reckless. And it might seem unfair, but then you also get it because you're like, oh, now my coverage is cheaper. Because what if they just approved everyone who applied? Well, then all of a sudden they would have to factor that risk in. And then the cost for everyone goes up because of a few bad apples because they have to cover that risk. So you almost want the insurance company to be pretty strict with their underwriting because that means you're not paying the same premiums as someone who maybe isn't as healthy or, does different activities, maybe a little bit more reckless than you kind of thing.
Yeah.
Yeah. So that's critical illness. I feel like the last one is life insurance. Any questions on those two before we move on?
So far, yeah.
That's good. And critical illness and disability are considered living benefits because it's like while you're alive, you're going to get paid out. Life insurance obviously is life insurance. Everyone kind of understands this one. How it works is if you pass away while you have a life insurance policy, a big amount of money, completely tax-free, gets paid out to your beneficiaries. So the people you love and care about, you list whoever you want as beneficiaries. You could list individuals, you could list a corporation, you could list a trust. There's a lot of different people you can list as a beneficiary. Same thing with your disability and critical illness insurance. You could list whoever you want as beneficiary. While I'm on that topic, I should probably mention, generally, rule of thumb, I always say disability, you're going to want to pay for that personally. Reason being, if you suffer from a disability, you want to receive that money. You don't want it to go into your corporation and then you have to dividend or salary it out to yourself. You could do that, but it just doesn't make a lot of sense in my opinion.
Interesting.
Life insurance, almost always you're going to want to pay for that through your corporation. And that's because thanks to the Income Tax Act, life insurance proceeds can come out of the corporation through what's called a CDA, capital dividend account, tax-free. There's some stipulations there. I'm not going to bother going into it right now, but pretty much it comes out tax-free out of your corporation. Okay. Critical illness, I always say it's up to clients. You do what you want. If you pay for it through your corporation, yes, it's easier to pay for because it's with corporate dollars and those are taxed less heavily. But then the critical illness amount that you're going to get paid out is also going into your corporation. Then from there, you have to dividend or salary it out to yourself. Whereas if you pay for it personally, yes, you're paying for it personally, meaning it's harder to pay for because those dollars are taxed more aggressively. But then when you receive that money, it's completely yours to do whatever you want with tax-free. So there's that trade-off. There's that double-sided sort of coin. I think that's a little bit more case by case. I tell clients it's up to you as to how you pay. Once you
No,
know
I
the
had no
difference.
idea, I had no idea that that would affect it, but it makes complete sense. Yeah.
Yeah, so those are kind of the ways to pay for it. There's another critical illness like strategy called split dollar or shared ownership, and like you could pay for a portion of the coverage through the corporation and a portion of it personally, and you know how it has a return of premium option. You can trigger that and then get that money out of your corporation tax free. It
Um,
has to be set up very, very specifically. You have to do a lot of paperwork and make sure it's coded correctly. But I'll be honest, CRA, while it's technically on side, as of today, they do not
like
like
that.
that stuff. Yeah, you do that, you're almost asking to be audited if you do
Mhm.
that. Now, mind you, people do it. I haven't done a lot of them. It has to make a lot of sense for us to do it. But yeah, I always say like you're just better off going one or the other. Don't
Yeah,
bother with that stuff. CRA is the one person you don't want no problems with, man. They are Thanos. Yeah, you just don't want to mess with them.
that's fair. Yeah.
Yeah. But yeah, coming back to life insurance, pretty much it's designed to make sure if I pass away, that the people I love and care about are going to be protected. And I would say if I can't physically be here for you, it's going to let me financially be here for you.
Yeah.
Now, there's two types of life insurance. There's temporary, and then there's permanent. Permanent, there's universal life, there's whole life. There's stipulations between the two. I'm not going to really dive into this nitty gritty between universal life and whole life today, just because it's not worth the time. But let's just talk about the difference between term and whole life or permanent or universal life. Term life insurance is straightforward. Everyone kind of understands it. You pay for a policy for a set number of years. You have a set amount of coverage, and your payments stay the same for that term. Term stands for temporary, but let's just call it term. You could choose a term between 5 and 50 years. That's the longest. You could choose, 5 years, 20 years, 30 years, 40 years, 39 years. You choose whatever number you want between 5 and 50. Let's say you get a policy for 20 years.
Hmm.
Your payments are set in stone for that 20 years. Your coverage amount stays the same for that 20 years. And at the end of the 20 years, you technically have three options. If you didn't pass away within that 20 years. If you did pass away, I would show up at your house with a check for your wife or your husband or your kids or whoever. That's
Yeah.
tax free. They do whatever they want with that money. They pay off mortgages. They whatever they want with that money.
Yeah.
But if you bought a 20-year policy, you have three options at the end of that 20 years. You can either just let it expire. So you're just like, okay, cool. I don't need my coverage anymore. I'm going to let my policy lapse. You don't get your money back, nothing like that. It's done. One and done kind of thing. Or you can renew it for another 20 years. No medical exams, no health questions. You just renew it for another 20 years. But the cost is going to go up because you're 20 years older now. And in theory, 20 years closer to the day that you die. So the cost is going to go up. Or at any point during the contract between, you could do this after the first 30 days. You could do it all the way in the last year of the policy. You can convert your policy from a temporary one into a permanent one. No health questions, no medical exams. You're guaranteed that conversion depending on the type of contract you have. Most of them have that conversion privilege. But again, the cost is going to go up when you make that conversion because you're older now, but also you're converting over to a more robust or luxurious product is what I'm going to say. I'll talk about why I call it luxurious. I would say term life insurance, like you get it. Actually, we'll talk about when you get it. We'll talk about that later. Let's talk about permanent life insurance because then I can give you the analogy.
So it's a
Permanent,
G-Wagon.
yeah, permanent life insurance is a G-Wagon. Yeah, if someone's on Spotify or Apple, they're not going to see this. On YouTube, we'll see if we're actually going to post this. Like I said, I haven't decided if I'm going to turn this into a course or like whatever, a free course. I'm not going to be one of those guys who says buy my course.
This is a high
Um,
end. We're high end cars. We're talking about different. Yeah.
yeah, exactly.
The high end.
But permanent life insurance is different. It never expires, meaning you can't outlive it like you can with a term life insurance product. Meaning when you pass away, that's when it'll pay out.
Mhm.
There's also two other key differences with permanent life insurance is that number one, if you set up your policy correctly, the coverage amount will grow. So like, let's think about it. Let's say you get a $1 million policy today, 30, 40 years from now, it might be worth a lot more than $1 million. It might be 2 million, it might be $3 million of coverage amount. So the coverage grows over the years. And then the other key benefit with permanent life insurance, again, if you structure your policy the correct way, there's cash value inside that policy that you can use. Now, you can cancel your policy and get all your cash value back, or you could take a loan against your cash value and use it for things. That's kind of the main difference here. Now, what's the difference between the two? I always say term life insurance is like a Honda Civic. Anyone who buys a Honda Civic is buying that car because it's the cheapest way to get from A to B. Term life insurance is the same. It's the cheapest way to make sure that the people you love are taken care of. I call like term life insurance like your get rich or die trying fund. It's like, hey, while I'm building my wealth, I'm going to have this coverage to make sure if I pass away while I'm building everything, that the people I love and care about are protected. That's really what it is. It's the same thing. It's like nice and simple. Term life insurance is like a Honda Civic. That's how I look at it. People buy Honda Civic for purely for transportation. People buy term life insurance purely to make sure a liability or people that they care about are taken care of if they pass away while they have the policy.
Gotcha.
Permanent life insurance, more like a G-Wagon or use whatever car. I love G-Wagons. That's the car I'm going to use. It's more like a luxury vehicle because anyone who buys a G-Wagon or a luxury vehicle, like, yeah, they're buying it for transportation. Sure, it's going to get them from A to B, but that's not why they're buying it. There's a reason beyond that, whether that's status, experience, maybe they love engineering. Who knows why people buy luxury cars. Permanent life insurance is the same. Anyone who buys permanent life insurance, they're buying it typically for a reason beyond just like, oh, I have a mortgage or I have young kids or whatever. There's a reason beyond that they're buying the permanent life insurance. And like everyone has different motivations for why they buy these policies. But professionally, I feel like they tend to fall into one of two buckets. Generally, there's obviously other buckets, but one of two, actually maybe one of three different buckets. The first bucket is like the most common and the most traditional way of buying permanent life insurance. It's for people who are older, who have amassed a lot of wealth, and they're worried about, okay, when I pass away, when me and my wife pass away, and we're going to pass on all these assets, this business, this real estate, all these assets I've accumulated over to my children are going to have to pay a lot of tax when they inherit those assets because the government taxes you when you pass away. And like, without, again, going into the nitty gritty of this, they pretty much tax everything you own when you pass away, minus a few things that aren't taxed. Life insurance, your primary residence, and your TFSA. Everything else is up for grabs.
You never escape the tax even when you pass away.
No, you can't. You can't. Death and taxes, right? They say there's only two things you can't avoid. And like I've always said, like inflation is another one. You add death, taxes, and inflation, but inflation is a tax in my opinion. So it's like you're getting taxed, and you're dying. Those are the two things that are guaranteed. So that's like one common way. And I'll give you an example. I had a client. They had a very large real estate portfolio. Let's say it's worth $20 million. They bought it for like $5 million. If you think about it, capital gains on that. But the capital gain is $15 million, let's say. Appreciated $15 million on that property. Now you're going to pay the capital gain rate on that. Let's just assume it's all in your corporation. And as of today, that's 2/3 of your gains. So you're paying 2/3 of $15 million. You're paying tax on that. You can imagine that tax bill is going to be massive for those kids when they inherit it or those properties. And here's the tough thing too, is when you inherit those properties from your parents, if they have mortgages and things on them like that, you now have to qualify for those mortgages. What if because those loans get called by the bank. What if you can't qualify for those mortgages? Maybe you don't have the income. Maybe you don't have the assets. Maybe you don't have the relationship with the bank to make that happen. Now, all of a sudden, you have to sell properties and pay tax on them just to fund the tax bill or the loans. And so very commonly, more, let's say, affluent or wealthier families will use life insurance as a tax planning tool to make sure that there's succession between the assets from the parents' generation to the children's generation. And there's there's so many other ways and use cases for life insurance, but that's like a really common one. I would say the oldest and most long-standing one is using it that way.
Gotcha. Okay.
Yeah. The second reason I feel like people buy permanent life insurance is ever since, I believe it's 2018 exactly was the year. This is why rich people hate Justin Trudeau. But if you have assets inside of your corporation and you earn passive income on those assets, you're going to be taxed very, very aggressively on those assets. And so what happened was, if you think about it, if you have a corporation, holding corporation, or you maybe even own a stock portfolio through your DPC, which a lot of people do, as that appreciates, if you were to sell any of those assets or make passive income on those assets, you would pay a lot of tax on it very aggressively. So you're not only paying a lot of tax on the actual asset, but then you also start to lose your small business deduction. You know how like right now, if you make less than 500K in your corp, you pay about 12% tax on it. Yeah. You would start to lose that privilege. And if you make $150,000 in passive income, you lose your small business deduction outright. And $150,000 in passive income seems like a lot, but if you can imagine, that's like one real estate property in Ontario or BC. So all of a sudden, you made money on the sale of this. You're not just being taxed on that, but you're also losing your small business deduction inside your corporation. Mm-hmm. And like obviously in your personal name, you have the TFSA, you have the RSP, you have these tax sheltered investment accounts. Inside your corporation, there's no TFSA, there's no tax sheltered accounts. It's all non-registered. Yeah. And so you can use life insurance, universal life insurance, whole life insurance to act as a way to shelter some of your passive income or some of your assets from that type of income. It's a tax sheltered way. Because as you remember, there's a cash value that grows inside this permanent life insurance. That cash value grows on a tax sheltered basis. So we'll have a lot of clients. Let's say I have a DPC. I did a policy like not that long ago. Client makes very healthy income. He has, he owns his house. He has a TFSA. He's got his disability insurance. He's like very secure financially on the personal side. On the corporate side, he's a large corporate investment account. And now we're like, okay, you're starting to make a lot of money, passive income wise. We need to start sheltering some of this money in a tax sheltered manner. And so we would buy permanent life insurance for that kind of client and start filling that policy up with cash so that that cash value grows on a tax sheltered basis. Now, obviously, he's going to have a life insurance need. He has a wife and kids in a clinic. And if he passes away, the life insurance will wipe that out. But now you're getting a secondary benefit of, oh, some of the cash that I have in my corporation is also being sheltered. Yeah. Now, sounds amazing, right? You're probably thinking, why the hell would I ever get term life insurance? I should just get permanent life insurance. Permanent life insurance, very similar, going back to our example, Honda Civics, or I don't know what they cost these days, 50 grand, 40 grand. A G-Wagon, what, you're looking at 300, 250, 300, 350, depending on, the specs. The same thing with life insurance. Term life insurance, very, very cheap. Permanent life insurance, very, very expensive. That's why I call it a more luxurious product. You're paying a lot more, you're getting a lot more, but you're also paying a lot more. So it has to be a very nuanced discussion as to whether you need permanent life insurance or not. I feel like dentists fall prey to this so much. Everyone comes in, they go, Ricky, do you want your life insurance to expire, or do you want it to last forever? You're going to say you want it to last forever. Ricky, do you want your life insurance amount to stay the same, or do you want it to grow? You're going to say you want it to grow. Ricky, do you want your life insurance, all that money to go to waste on the term policy, or do you want it to grow and you could use it and leverage it and invest like the top 1%? You're obviously going to say the latter. Now, I just sold you permanent life insurance. Do you need it? Probably not. It really is in my opinion, a very unique and niche product for individuals who are either very, very wealthy and older, and they want to pass down assets to their children, or someone who has a lot of assets inside of their corporation and they need a way to shelter some of that from taxes. And then, sorry, the third one I forgot to say is some people want a way to diversify. And that's where I would say whole life insurance really shines. Like, yes, they have their stock portfolio, they have their real estate portfolio, and it's just one more type of asset class, which is the participating fund inside whole life insurance. It's just another way to, diversify, because that investment account, that participating life insurance account, is managed in a way very different than how you and I would invest, let's say. Those are kind of like the three reasons. And the last thing I'll say about the permanent life insurance is generally, you have a permanent life insurance policy, you have to be very, very careful of the structure and how it's set up. This is where conflict of interest, once again, shines through quite a bit. I can't tell you how many policies I look at on a regular basis, and I'm like, why do you have this coverage? And more importantly, why is it structured this way? There's so many policies I look at that I'm like, it should not be structured this way. This is not set up in your own best interest. You have no flexibility with the product. And more importantly, you're paying all this money for a product that's inferior to another product you could have set up with just the cash value is higher, the death benefits higher, and you have more flexibility. So it just really has to be set up correctly.
Yeah. But yeah, I guess we could also talk about that. I know it's probably like a relatively kind of taboo topic. It's like when dentists refrain from talking about their salary, but for brokers or whatever it may be that may be helping you with this, obviously, technically, the more quote unquote they sell you, the more that they make. Is it something that's is it an ongoing payment? Is it something like a one-time payment, or does it depend on the policies and whatnot and how they get paid? And that if someone's going to come to you that you're looking at your best interest, do you kind of go to multiple people and kind of assess? Do you just trust them, or?
Yeah, honestly, it's really hard because I'll say this. Yes, commission-based work, there is room for conflict of interest, but I don't want to paint all advisors as bad. I'm an advisor myself. Now, mind you, I think I was saying I'm quickly turning into the most hated advisor I feel like that I know. I have no friends in my industry. Shout out to Drake. I really don't.
That's not a bad thing.
Yeah. And what happens though is that commission-based work isn't terrible. It's just there's room for conflict of interest. Yes. But you might have a really great insurance advisor. And if they got paid a commission, that doesn't mean they're a bad person. It's just how our industry works. You get paid a commission for selling a product. there's a fee-based way of doing things, but then you now need to go and like, let's say, for example, I tell you to get a certain insurance product if it's fee-based and I only get paid my fee, I don't charge a commission or I don't get paid a commission. Now you have to go to the insurance company and get, the product yourself. And like, then you start wondering, okay, is the insurance company now going to sway me a different direction? I have to do the application myself. I don't know about the nuances and the nitty gritty about these policies. So like, it's better to have an advisor do it for you. How advisors get paid on insurance is you get paid a one-time commission upfront. And that commission is typically based on how expensive your policy. It's not based on how large your policy is. It's based on how expensive it is, what your monthly or annual premium is. So the more expensive a policy, in theory, the more commission that you make. Now you get paid that commission upfront, but then you also do receive what's called a trailer, where you receive ongoing, sort of recurring money from those policies.
Yeah.
Now, term life insurance, like the cheaper policies, you don't get paid a lot of a retainer afterwards or that trailer. It's very small. Like even me, if I was to add it up, I have no idea. Like I don't even count it because it's not even income. Like it's probably Starbucks money for the month or something like that. It's very small.
Pretty minimal, yeah.
Whereas the permanent life insurance products, like the whole life, the universal life, those have larger trailers on them. And so there is a added incentive because you get larger money up front and larger money ongoing. Again, it's not how it was set up in this industry was that trailer was meant to be incentive for you to continue talking to your client after you've sold them a product to make sure it still aligns with their goals and their life and all of that.
Yeah.
Now, mind you, that's almost never happened. Like I'm sure a lot of dentists can attest to this. Someone comes in, they sell you a product, you never hear from them again until it's time for you to get more coverage, increase your disability, or until they have some new idea for you to get more insurance. But between that period, you do not hear from your, financial advisor, which is, I think, a key distinction to make. Someone who sells you your insurance and never talks to you again, that is not your financial advisor. That is your insurance broker or insurance advisor. Your financial advisor is someone who should be talking to you about a lot more than just insurance, and more importantly, constantly following up with you to make sure that what they recommended to you today is still in line with what, your life is today. Or more importantly, ideally, I feel like a good advisor is going to be like, hey, this is what happened in the news or in the world. Here's how it impacts you. Like realistically, for example, these new first-time home buyer rules as of December 15th. Ideally, your financial advisor should be reaching out to you proactively or a few days after the news and say, hey, Ricky, this actually impacts you. We should hop on a call and talk about how. And I'm going on a whole tangent here, but I feel like that's another reason why you shouldn't have an advisor with like thousands of clients. Like, sure, you could have thousands of transactional clients. Like, for example, with White Coat, we crossed over like 500 or 600 clients so far since 2019.
That's awesome.
But that's not 500 or 600 clients I actively have a relationship with. That includes people I just did their insurance for, or I just did their mortgage for. Actual clients who like I talk to on a regular basis, I manage their investments and I'm invested in their life, that number is way smaller. There's debate in my industry about as to how many people that should be. I feel like 100 or 200 in between that number is probably ideal. Maybe even less than that is probably the ideal number of actual like fee-based ongoing clients that you should probably have. So if you're relying on your insurance advisor, I'm going to bring it back, that huge tangent. If you're relying on your insurance advisor to provide you financial advice, you almost can't even get mad at them. Their pay incentive isn't structured for them to provide ongoing advice. It's incentivized for them to find as many people as they can, sell as much insurance as they can, and move on to the next. So like, just be mindful of that. When you said like, oh, how do I know if my advisor is giving me the right product, etc.? I feel like to a large degree, just know that if you're dealing with someone who just does insurance, they obviously are incentivized to sell a product and move on. And like if you're dealing with your financial advisor, they should be incentivized to, even if they give you insurance, to work with you consistently after that. Google reviews are important. Designations are important. Do they have their CFP? Do they have their CLU? I would say those are the minimum from an insurance standpoint. That's what you want to look for. If they don't have those two, bit of a red flag. Maybe the CFP minimum. If you have the CFP, I would feel like it's okay. Or if you have the CLU minimum, that's okay. If you don't have one of those two and you're doing insurance, I feel like, again, a bit of a red flag. So Google reviews, designations, experience, industry specific, and then just, word of mouth. But like, man, I don't want to sound bad here, but even that doesn't really mean that much. You almost have to just trust their character and who they are as a person, because I could have the designations and I have a bunch of dental clients and, you don't, you can't tell a good advisor from a bad one. You just
Hmm.
can't. Like, I don't know a good dentist from a bad one. If someone goes in and they fix my teeth or whatever, I don't know who a good dentist is and who a bad one is. The same way I don't know who a good physician is and who a bad one is. Um,
Hmm.
those terms obviously are subjective, but it's tough to know who's a good advisor and who's not. I would say someone who just acts in your best interest, and like, there's no black and white way to determine that, unfortunately.
Yeah. And I
Yeah.
guess the other point to make is obviously with insurance brokers, they don't really know, they usually don't know your financial structure, your financial plan. So it makes sense to have someone that are is doing both because they can at least obviously, from what everything what we've talked about, it's it correlates. It runs in parallel with your financial plan, your you know taking that into all that into consideration. So it can affect what terms you go on and what options you go with and whatnot. So obviously there's a direct correlation. It's not like there are two separate entities and you kind of have an insurance broker, financial advisor, and like all these little parts. So that's why obviously it's great to go with someone like you just because, and again, it's not to boast you or anything, but you understand the whole structure, the goals of financially, work wise, and all that, and how it comes into play all together essentially. So I think that's also important. So I guess in that scenario, even you can even you know, be mad at insurance brokers sometimes for not
Mhm.
setting up things correctly because they don't really know what your goal is and they don't know what your financial plan is.
Or
So
they're not being paid to do all that.
yeah.
Like, I again, and this is where, like, again, I appreciate the kind words, and why I'm doing this is not to get clients and all that stuff. I think I've said this at some of my talks, is at a certain point in time I'm going to stop taking, because like I said, there's only certain people, a number of people that you can work with. I feel like that number is going to happen by the end of 2025. I might be done taking clients in like
Yeah.
9 months from now, but this stuff will live on, or at least I'll continue doing talks, so that even if you're not working with me, you might be working with someone on my team, or you might be working with a completely different firm. At least you're equipped with the tools and the skills and the knowledge, at least baseline, to know when something's not adding up here. But to go back to that point of financial advisors, I don't want to sound like I'm anti-advisor. I'm literally an advisor myself.
Mhm.
I want to make sure that people understand the tools, and they know about the different pay structures and what you should look for. And I feel like the general rule I kind of want to say is that you almost can't even get mad at your insurance advisor, like you just said, because they might not understand the whole concept. They might not, have a intimate understanding of what your goals are and what the rest of your financial plan looks like. And I
Yeah.
would say generally across the board, you don't want financial advice that's given in a vacuum or that's siloed. You kind of want, in an ideal world, an environment where someone understands every aspect of your finances. They understand your tax structure. They work with your accountant. They understand the legal structure. They understand what's in your will. They understand your insurance structure. They understand what you're doing on the real estate side. They understand what you're doing on the investment side. I feel like, to a degree, like, this is what I'm trying to do with giving this content, is I'm hoping that my industry, like, you as a dentist, start demanding more out of your advisor so that it improves this standard of care in my industry. Because you
Yeah.
ideally want someone who understands you intimately, who knows
Mhm.
you well, who knows what your goals are, who knows you as a person. And then you can only provide advice beyond that, instead of just churn and burn, see 1,000 clients, don't really remember or understand who any of them are, and just kind of generic, here, here's a product, here's what I think you should get, on to the next. And like,
Yeah.
that model worked for a while, I think, but if you're looking for, a standard of care beyond just buying a product, then yeah, that's what you should be looking for. And honestly, in the world that we're in right now, with AI and all that stuff, like, as an advisor, yeah, you'd hope that you're providing more than just knowledge, and you're not just a commodity to buy a product. Because I wouldn't be surprised in like 5 years you could just kind of like go online and do everything yourself. You'd hope that someone understands your situation. You're getting advice that's not just commoditized.
Yeah. It's like healthcare. Like you can go on and search up, what you're feeling and whatnot, but you need somebody to, kind of guide you through. And it's kind of again like general dentists, for example, and specialists. Like you have your quarterback, which is kind of like what you are, and you can kind of refer to all these different entities, whether it's insurance brokers or mortgage brokers, that way, you have someone that's understanding you and directing you to the right places as well.
Yeah.
So it ties in similar to kind of what we all do essentially as well. All industries, they're all pretty much similar. They're all, completely different in ways, but they're also very similar in a lot of ways as well.
Yeah, you nailed it on the head. Like, yeah, you're 100% right. You have your general dentist, you have your specialists, and you'd hope that your general dentist does what they can, and then they refer you out to the other stuff, and that everyone communicates ideally too, right? That's obviously really important when it comes to treatment planning. I've been to a few CE events, and I'm like watching these guys, and like, oh, the orthodontist did this, and then the oral surgeon did this, and then the perio did this, and it's like, oh, you had three people working on this case together, and that's honestly the ideal environment. I feel like,
Exactly. Yeah, yeah,
especially if
100%.
it's complex. So.
So,
Honestly, I think that's probably the best place to end
yeah,
it. And we kind of talked about what disability insurance is, the different features. We talked about critical illness, the different features, the life insurance. And there's like a lot that I probably missed in this because it's such a, vast topic and there's so much nuance and all that. But I'm hoping that when people listen to this, they kind of understand the difference between all of these because I feel
exactly.
like the only time people get educated on this is when they're in dental school and they're like, man, I don't care about any of this. I'm just barely surviving. I'm hungover. Like, I got an exam next week. There's a cute girl in the front of my class. Like, that's what
Right.
they're thinking about. And they're like, give me my free pizza. Go ahead, give me your spiel and let me move on. Like, that's the only time you guys learn about insurance is when you're in dental school. And then when you finish, you just never learn about it. You just kind of signed up for whatever. So I'm hoping that this is like a refresher, hopefully for
Yes,
people.
100%. And I guess just to kind of go on to that point, it's probably beneficial for, even older dentists to kind of review their plans as well, obviously. So this isn't just for newer dentists, but it's also good for older dentists to kind of review and kind of reset in a way. And yeah, so this has been super helpful. Obviously, I know this is, general opinions and recommendations, but if people have, more specific questions, it's best to contact you directly and kind of go from there.
Yeah, message me,
I'll
message
contact
your own
them.
advisor, whoever it is, message someone. Just
Yeah.
make sure what you have is right for you and obviously get a second opinion or whatever the case is. But yeah, I really hope this doesn't come across as salesy because that's not what this is
No,
for.
no. Yeah.
It's just like, all right, now that you understand these, you can look at your own policies and be like, cool, does this align with what I have in my life? And what I
Exactly.
need. And you're absolutely right. If you're an older dentist who set this stuff up a long time ago, hopefully it's been updated to be aligned with your life. And like, yeah, I have a lot of clients who are like get into their 40s and then maybe into their 50s. And now you're probably thinking, oh, I have this term policy. Maybe it does make sense for me to switch over to a permanent, or maybe I can actually cancel my critical illness because I'm self-insured, or maybe I don't need my disability anymore. There's certain features I can remove now. And so like, yeah, it's not a one and done. You should always look at this stuff.
Yeah.
Yeah.
Ongoing thing. Awesome. Thanks for all the information. This has been awesome. It's been a great refresher for me because, it's like just like you mentioned, you forgot all about a lot of these things, and that's been good.
Yeah. No, I think that's solid. The information discussed in this podcast is for general information and educational purposes only. It's not financial, legal, tax, investment, or insurance advice, and it's definitely not a recommendation for any specific products or services. Everyone's situation is unique, so if you're thinking about making any financial decisions, make sure to chat with a qualified professional who can give you advice tailored to your specific circumstances and financial goals.